I'm going to get back into the YieldMax ETFs. However, before I start, I do want to preface that I've been gone for about 3 weeks, so I know I haven't made videos, but I'm going to be back very consistently. I have an editor now, so things are going to be a lot better, and it'll make the videos a lot more concise. However, let's get straight into today's YieldMax overview. It is the end of June. We are at about 200 or so in income from the YieldMax portfolio that we've put together, at about a consecutive yield of 34%. Now, what's imperative to know with these funds is that a lot of them, as I'm going to get into later, have something called NAV erosion, whereas basically the net asset value goes down. The reason this happens essentially is because the funds are returning your own money to you. It's called return of capital. I believe we went over this in a previous video, but it's imperative for you to know this because it is what we're about to get into later, but you need to change your investment strategy when investing in these YieldMax funds to kind of be aware of that scenario and be able to limit your downside by managing that NAV erosion, right? We need to understand this when we're investing in these funds. And the reason NAV erosion is so important is because I project is going to happen with these funds is that eventually over time, they're going to go down, and it's eventually going to get to a point where we need to have a reverse stock split for the value of the stock to go right back up. And this is going to continue happening in a cycle if we're using a time horizon of, say, 10 years. Now, these 10 years, we're going to have maybe 1 or 2 reverse stock splits, maybe 3 in that time period, because as we see these distributions getting paid and we look at what's actually in the distribution, if you guys have, looked into this and what is going on, it is all return of capital for the most part. Now, this is not a bad thing, but it's important to know, right? When we're investing in these funds, we need to understand what is happening, why it's happening, and essentially where the money is coming from. Follow the money, to follow the paper trail, right? So that's the first thing I want to really emphasize is you need to use a strategy when you're investing with YieldMax, right? You can lose money when you're investing with these funds, so you need to keep in mind to employ a strategy. My personal strategy is to either buy back into the funds when they've gone down a bit in value, or to use the distributions to buy SPY, QQQ indexes, or other stocks that I find interesting, right? The other half, I either just live off of it after taxes or I reinvest in other stocks I find appealing. So this strategy, I am able to kind of move the money around, benefit from the yield, but also limit myself from that exposure to the NAV erosion by reinvesting into the funds after tax. And remember to take your taxes out, guys. Again, I'm not a financial advisor or a CPA, so do your own research. This is not, financial advice. This is entertainment, as I need to say. But you need to look into this when you're doing this because you guys need to understand what it is you're investing in, and you need to understand what is your roadmap, what are your goals when you're investing, and not just blindly, throw all your money into these funds because you see, Joe Schmo and Joe Bob, the guy across the street talking about YieldMax, all these interviews coming out and all these things. Now, I also would like to preface what I'm about to say by saying that these funds are not also horrible. It's, they're good securities, they're good things to invest in, but you need to understand what is going on. Like I said, follow the paper trail. Now, if I was a new investor in YieldMax and I'm seeing all these videos and people talking about it, what would I invest in, right? So these are the 3 funds that I would pick to maximize the yield. The first one would be NVDY. It has about 105% yield as of this video coming out. And I would highly recommend this because as we've seen NVIDIA's unprecedented run over the last, year and a half, there is still some room for it to go, but we need to understand that it is probably one of the safer YieldMax ETFs to invest in because the fact that NVIDIA is starting to kind of stabilize in price. And we've seen slight pullbacks, but we haven't seen a major pullback yet. But again, like I said, with these funds, there's something I'm going to say later, but the market that we are in, whether it's a bear market, a bull market, or we're trading just sideways, is very imperative when investing in these funds, right? Now, these funds are actively managed, but we also, as investors, need to be actively managing our portfolios to limit our downside, right? We need to look at these every other day or, every week. Maybe I would say every day for myself personally, but we need to look at these funds so we can understand what is going on, whether we're entering a bear market, whether we're in a bull market, because again, if you believe in the underlying, what you should be doing is taking the yield from this to buy the underlying stock, right? That way you can not cap your gains, because when you're investing these, it's capping your gains. But like I had said, I'd gone over NVDY. The second fund I would pick is MSTR, which is MicroStrategy. They're heavily bullish on Bitcoin. Now, if you believe in that, then you'll have some upside with MicroStrategy. But the only thing is, again, with these funds, it's capped off, right? MicroStrategy, if it goes up another 30%, you're not going to get to participate in all of those gains because, again, these funds do not hold the underlying securities. They are just options income funds, and they utilize return of capital to do this, right? Now, the third fund I'd pick in a traditional YieldMax portfolio, I know some of you guys just pick YMAX and would just run off with that, but I would pick ULTY, and the reason for it is because in this hypothetical portfolio that we have, we need to have a multi-stock, essentially YieldMax fund, right? The other two are single stock exposure. We're exposed to NVIDIA, and we're exposed to MicroStrategy. Now the third one is ULTY, and that has access to multiple stocks, so one of them being CleanSpark, which is a good company that I believe in. But you guys need to understand what these funds are invested in. Go look at the prospectus, go do the research, look at what's in there, look at what they're holding, because nobody else is going to do that for you. And if you blindly throw your money in things and you don't understand what they are, you're going to lose money, and that's just the end of that. So if you're not willing to do that, I do not recommend investing in these funds, and that is my perspective. However, these are the July distributions from the portfolio that I've just gone over. I could show and break down the portfolio, but I'm not really going to bother with doing that at the current time period, because I think it's more important to kind of go over the time periods of what's going on, what's going to get paid when. And as we see, the Defiance funds and two other funds that I have that are a lot safer than these ones in terms of the NAV erosion not happening are JEPI and JEPQ, which provide around, 8 to 10% in yield with monthly distributions. 8 to 10% a year, though, not monthly, unlike some of these YieldMax funds. But I also hold some bonds in the portfolio. That's just to hold some cash so I can see what's going to happen and also be able to take advantage of opportunities as they come, right? When we're investors, we want to be able to take advantage of opportunities as they come. If we're not doing this, then it's not a good thing, because you never want to have no cash in your portfolio, even if you're just a YieldMax investor, right? And then we've got all the other ones that are coming in: MSFO, Microsoft, Netflix, NVDY. The reason I do this is because I have a slightly larger portfolio size, so I like to not just throw all my eggs in one basket and just go all into YieldMax, right? But I think this calendar, it speaks for itself. I don't need to go into every single distribution date, but you guys can pause this video, look at this if you want to see the specific dates. If you guys want to look at the things that I'm holding, this is an example of what's paying the dividends in this portfolio, right? Now, what should you do, right? If you're looking at YieldMax and you're seeing these videos, you're learning about it, you're hearing it in the dividends community on Reddit, what should you do? Now, this really depends on your financial scenario. Are you extremely rich? Do you have $1 million to invest? Or you have 20 to 30K, or you even have 5,000? Again, I'm not a CPA or financial advisor, so do your own research. This is not investment advice, but what I believe is if you are that rich guy and you're like, hey, I have $1 million to invest and I want to maximize the yield, but the 4 to 5% is not really doing it for me. These financial advisors are recommending me to get these 4 to 5% or get 6% from an annuity, and I don't want to do that. What I believe is you should have an LLC and form it in a place where there's no state tax. Again, this is not advice, but this is what I think I would do in this scenario. And this way you only pay the 21% in taxes on that LLC, quote unquote, holding company, right? This is the way to maximize that yield and take yourself out of paying 40 to 50% taxes on that $1 million, right? Now, this is another thing I want to get into, which shows kind of the insanity of the YieldMax funds. So let's take a sample scenario, okay? Let's assume you have $1 million and you're just like, all right, screw it. I have $5-6 million. I want to try this out. I'm throwing $1 million into ULTY and I'm not touching it. I'm reinvesting the dividends, all of them. Now, what we're going to do is, in this hypothetical scenario, we have about 99% yield, and we're going to presume that 99% yield does not change. However, as I mentioned before, there is NAV erosion. So what we're going to do is we're going to understand that, and we're going to take about 39% of that yield out and assume that it goes either to taxes or it goes to reinvesting back into ULTY to counter that NAV erosion. Now, if we're taking a number of 60% a year compounded over a period of 10 years on $1 million starting, the number is absolutely ridiculous. You're looking at a 348x from $1 million to $348 million. Now, this is another thing that makes me a little bit worried about the YieldMax funds, to think we don't see investments like this every day, right? So are these funds going to really be around in 10 years? Because around every 10 years, we have some sort of market cycle where we have a large pullback. we nearly need to see what's going to happen with these funds in a pullback, because right now everyone is very, very bullish on everything because of the NVIDIA run we've had and AI and all of these things. But how are these funds going to do in a bear market? Nobody knows. And we won't know until it happens, which is why I said you need to be actively managing on this portfolio. For example, if we have a scenario where we have a bear market and there is a pullback, then you need to understand that, hey, I need to actively manage this portfolio. I need to pull out of these funds at this time, let them come down and get back into them before the ex-dividend date. Now, that is a little bit more complicated than the people that want to be just, set it and forget it investors. However, if you're going to invest in these funds with your hard-earned money, I think it's very important that you understand, like I said, how they work, how the compounding works, how the NAV erosion works, what they're invested in, and how to basically take advantage of these funds for yourself and be able to take advantage of the compounding. Now, is this sustainable forever? Probably not. Like I told you, in the scenario, we're probably going to have situations where we have pullbacks and these can do not so well. But also, what I think would happen in that scenario is there's a reverse stock split. People get, more shares, and people have the price go up. So if you have 5 shares, it becomes 1, and that's a 5-for-1 reverse stock split, and then the stock price goes up by 5 times. And that would be the way to keep the price at bay from going down to, 0 in like 10 to 20 years. But this is how they're going to have to do it in order to keep the NAV erosion at bay. Now, like I said before, understand what you are investing in. These are options income funds. They do not hold the underlying security. They are, I believe, doing weekly options on these funds, and they're employing return of capital. And basically with these options, you have limited upside and the downside is uncapped. So if you have a bear market and a large pullback, you're going to feel that. Like, you're going to experience that. But this is all I really have to say. If you guys enjoyed this video, make sure to like and subscribe, and I'll see you guys in the next one. Peace.